Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab. And this is long verticals and diagonals. And today we're going to be talking about a strategy that's specific to diagonal spreads. And it is using charts to spot what some traders refer to as an income window. With those diagonal spreads, we know there's the side of the trade that offers the opportunity for appreciation. The other side is more oriented toward income. So we're going to be talking about the income side of things. I think it's going to be a great discussion. We're going to be using an example trade today. But before we can get to any of that, though, let me first of all say hello to everybody. It's already chatting in out there in YouTube. Great to see Josh and Lou, Janelle, Juan, Joe, David, Muralai, everybody else. Barat, thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the show. But be aware that you're invited to join us in the live presentation. This is a Thursday webcast series. And if you'd like to join us live, we kick things off promptly at about 11 o'clock Eastern time. Hello there, Muralai and Kevin and JR and Dom. Great to see you all. If you're here for, well, let me point this out. We actually work these with two coaches present. You have your presenter, and then as a special treat for my attendees in the live audience, we have my very good friend Brent Moore is going to be hanging out in the chats with us today. So thanks for helping out, Brent. Brent's going to be addressing any questions that I can't get to just during the flow of the presentation. Brent and I would also like to issue an invitation to everyone watching. If you have an account on the platform known as X, you should be following your favorite presenters there. It's the best place to connect with your favorite presenters in between these live streams. I literally 15 minutes ago was reading through some of the replies to one of my most recent posts. I've been replying just this morning to others. So yeah, best place to connect with us. You can find Brent there at Brent Moore's CS. You can find me on X at Cameron May CS. But let's get right to this presentation. And as we do, of course, we need to consider the risks associated with investing and trading. Risks are real. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal. I should highlight this as well, since we're going to be talking about charting a lot today. Schwab does not recommend the use of technical analysis as sole means of investment research, and any investment decision you make in your self-directed account is solely your responsibility. All right, so here's what we're going to be doing today. First, you need to know we're going to spend some time here reviewing existing example positions in our paper money portfolio. This is a webcast series that's tied to previous videos, so we're going to be following up on those trades. Then we're going to take a quick glance at what's going on with the markets. Another record, I guess, is the way we'll look at it just in the very recent trading. Then we're going to shift into discussing this diagonal spread strategy and specifically using charts to maybe identify what are known to some as income windows. I'll explain what that means. And we're going to place an example trade to sort of connect the theory of trading with the application of these concepts. But let's go right to the Thinkorswim trading software desktop platform. And here are our current positions. So we have 5 positions. We'll go through these relatively quickly. There is one that I think we're going to do something with today, and that is Apple. So here's our Apple position. We bought a 205 call for the 25th of July. That's tomorrow. We sold a 210 call for the 25th of July. So that created a long call diagonal spread. It's a bullish strategy where the preference is for the stock to be above the 2 strikes, so above 210 in this case, as we get toward that 25th of July expiration. We're right there. We have 1 day left till expiration, and the stock is now at 214.5. That's our market value of the stock at the moment. So when we bought this spread, see, we paid $9.80, received $6.10, $3.70 invested in a $5 wide spread. How much does that leave for profit? It leaves $1.30. So $1.30 on 100 shares leaves us with $130 of profit potential, maximum theoretical gain. Where are we right now? Well, we're at $117.50. So this one, we could allow it to just go to expiration. So here we are right now. We're above the two strikes. So there's the 210, the 205. We're above that. But there's always the possibility that in the remaining hours of trading here on Thursday, in tomorrow's trading on Friday, prices could collapse and we could see those profits surrendered. We could even enter into loss territory, maybe even to max loss territory. And in any case, if we wound up between the two strikes, the short call might be assigned. We sell some shares, long call expires worthless. That would leave us in a short stock position. So I'm going to close this out. Really only about what right now, as of right now, about $15 left on the table here. So let's right click on Apple. Let's create a closing order and sell that vertical. We just did one contract. This was a small example trade. Let's see if we can get out for 485. Can we try for that? Notice that's closer to the mid. When we get further from the natural, that can elevate the risk that we don't get a quick fill on this. There's always a possibility the trade might not fill, especially when we're using a limit order. But let's click confirm and send. I'm going to try to sell out of this vertical. We paid $370 for it. If we can sell it for $485, that would be our $115 realized gain. There are commissions still to be paid. $1.30 will chip into that credit, so reduce that gain a bit. And this is a reminder here, as though this were an opening transaction. This is a closing transaction, but there's a reminder here. Please note that you've selected a weekly option series because this was a weekly option series to get out before an upcoming earnings announcement. Anyway, with a non-standard expiration date. Let's send this order off, and we're going to let that work for a moment. That's sitting up here. Yeah, we're asking for a 485 credit. The mark is at 485. It might fill. We'll see how generous this is. Ted says, would you be more likely to stay in the vertical if it were much more in the money? Ted, I think that a number of traders might do exactly that. Yeah, if there were more distance, more comfort, if the trader was more confident that they could make it to expiration, they might be more inclined to stay in there, see if they could get that other $15. There's still big risk, though. There's $15 of reward potential in a $500 spread. How much does that leave over as risk in the form of the potential surrendered gains and losses? $485 in pursuit of the last $15. So that's a consideration. Anyway, we're out. I saw that order execute while we were talking. Yep, our quantity's gone to zero. So that's a realized gain. Very nice. All right, so next up we have our Broadcom trade. With Broadcom, this is another bull call spread. Bought the 270, sold the 280. We're at 287 right now. So we're above the spread, which is where we'd like to be. Let me show you this trade on our chart. So this is last week's trade. And you can see we discussed how it might just go sideways. That's okay. As long as we're above 280, the trader might still be all right with that. That still has us in position for maximum theoretical gain. But there's been some choppiness, just like we discussed. Look at this. I drew the line downward initially, and it came downward initially. Doesn't always work out just like that, but hey, sometimes you set out a hypothetical, and that's just what happens. Let's see if it can stick with this. Obviously, what the trader would like to see happen is for us to get some distance, go further up and up and up into our maximum theoretical gain zone, but we're there at the moment, so we're going to let that one continue to work. GILD has been a long call diagonal spread, but right now it's just a long call. And that's because there's an earnings announcement. Let me have a look at this. Yeah. We have an earnings announcement right around the corner. That's out there on August 7th. So we bought a call here. The stock has worked its way higher, so that call's done all right. Along the way, we've made some gains on some short options, looking for income. We've had a couple of losses back here, but we most recently had our, let me see. Those are just overlapping. Anyway, we had a short call right there at the 115 level that expired on July 18th for an 80-cent profit. And then our stock started going up right after that. That's just what you would hope would happen. With that earnings announcement around the corner, and we're just holding on to this long call, what some traders might consider doing is maybe selling another call against that expires before that earnings announcement. Now, not everybody avoids earnings with their short options, but there are potential pros and cons to carrying a short option through earnings. Right now, it's quite likely that the premiums offered are very high because the demand for options are probably pretty strong going into this earnings announcement. I can say probably with a fairly high degree of confidence because that's just sort of typical for a lot of stocks as we move into earnings. So we might be able to collect a large premium. However, it also puts a cap on the upside potential of our long call in the near term. And for some traders going into an earnings announcement, maybe they just prefer not to do that. I think in this case, let's see. And I think there's a lesson that might be taught here. Let's see if there's a contract that we might sell before that earnings announcement. And I want to talk about why some traders may choose not to even do that. So keep your eyes peeled as we go here to our option chain. Wait, our earnings, I think that was on the 7th of August. No. 7th of August. That's right. So as we go to our trade tab, you can see there are contracts for the 8th of August. Well, there's a problem with that if we're trying to avoid earnings. That's the day after the earnings announcement. So what about the 1st of August? I'm going to open this option chain up. I'm going to see if the scenario is still the same as I noted earlier today, and it is, maybe to a lesser extent. But some of you who are more veteran with these sorts of things, what do you see on that option chain that might cause some traders to hesitate? Even if they had the idea to sell a short call, they might say, nope, not going to do it. Well, as I look at our option chain here, stocks at 113, let's say we wanted to sell an out of the money call, 114, 115, 116. Look at the spread between the bid prices and the ask prices. There is poor sometimes in the eye of the beholder, but I would describe this as poor liquidity in these contracts. There's a very wide spread between the bid price and the ask price. Just to illustrate this, if we were to sell, let's say, that 115 call, the 115 is right here. It's just a little bit above where we are right now. Let's say we were to sell that 115 call and then get immediate seller's remorse and try to buy it back. Well, if we sold it at the bid price, we'd get maybe about 50 cents. Now it's only 30 cents. Let's say we get 50 cents. And we had immediate buyer's remorse and we go to buy it back and we pay the ask price, we pay $1. That's a 100% loss in an eye blink. That is the exposure of a wide spread between the bid price and the ask price. I think for some traders, they would just sidestep this, even though it expires before the earnings. That's nice for the trader who wants to avoid the earnings with a short contract. But I think we're just going to say for this one, we're just going to hold that long through that earnings announcement. Could go well, it could go poorly, but we'll see how that goes. All right, but let's go back here. We're going to leave Gilead alone. Then we have NVIDIA. Now, before we look at NVIDIA and UNH, we're going to hold our nose while we look at UNH again. But in any case, before we do that, let me say, I just noticed that there's been a survey that's been added to the chat window. So for those of you who are out there in the live stream right now, if you do me a favor, click on that survey link right now, then you can fill out that survey when the webcast is over and you can give me some honest feedback. That's always appreciated. It's just 2 multiple choice questions, super quick survey. Click, and you could be done. Unless you also want to leave some comments and some suggestions. There's also a comments box and a suggestion box. But I'll just tell you, if you take the time to fill out that survey, I always take the time to read it, and it always helps. It's never a wasted effort. All right. Thank you for doing that for me. Janelle says, yay, a survey. Yeah, we don't always get the chance to give the presenter some input. So I hope you take advantage when you do have that opportunity. But let's move on to this NVIDIA position. This is another long call diagonal spread where we bought the 145. That one has 211 days till expiration. Sold the 180. That one has 22 days till expiration. The preference here is for the stock to keep going up to help out that 145 call, but to remain below 180 so the short call just expires worthless. That would be 2-for-1 profit potential deal. Right now, the stock's at 173. Now, with NVIDIA, let's go have a look at its history here. Bought that long call right there. And initially, we sold a 170 short call against that. So that felt okay at the time. We thought, that'll probably just expire worthless as long as it's below 170 as we got toward that July 18th expiration. And the stock really rocketed upward. Great for our long call, but for our short call, we were in the money. We actually rolled that position, sold that or bought back that short call, sold another one up here at 180, but we did take a loss of 265 there. So that's not terrific. However, the long call is really having a nice little run here. Taking a $265 loss, but on our long call, how much are we up on that right now? Bought it for $30.85. It's worth $39.42, up about $8.50, $850-ish, $860-ish dollars. So $260 haircut that we took on the short. But the new one, the 180, sold that for $405. It's worth $272 right now. That one's actually doing all right. Starting to make up the gap on the other short where we already took a loss. So that's nice. We're going to let that one continue to work. That one still has, the short has 22 days till expiration. It's still quite a ways out of the money. Finally, we have our UNH. Everybody pinch your nose shut. This is the one that we took on January 9th. And the premise for this trade was, I wonder what might happen if a trader just took a position and decided in advance, no matter what happens, they're going to stick with it for a whole year. And so that was what we're doing with this one. And this is the lesson that we can take from that. We've tried and tried to help this thing out, but we bought a long call back here. And when this happens, it kills the value of that long call. This thing has really been beaten up. Now, we've sold some short calls against that as diagonals. Made an 860 profit here, 672, 370, 530, another 312 right there. So that's been a nice gain on the short positions, but we've taken much larger hit on the long. And so here we find ourselves with a long contract. Still has a lot of time left on it, 540 days, still 2 years. We're going to close it out at the end of the year, though. So a better way to look at this is we have about 5 months for this thing to start operating. Not even that anymore, 4 months. But it would really need to get up and get going. Now, there's an earnings announcement right around the corner here. We're not going to sell another short against this until after that earnings. But there's, Ricebird has all the emojis that express all kinds of concern and discouragement. Exactly. Yeah. Were there signs along the way, maybe that the owner of this long call might have decided, ooh, this isn't going how I thought it was going to go? Probably. That's the benefit of hindsight, though, sometimes. But in this case, there's our current positions. We made the one change to Apple, close that out. Nice little profit. Let's go have a look at what's going on with the S&P 500. And then we're going to talk about putting in today we're going to be doing another a long call diagonal spread. And here's why. Let's say that we're just a technically oriented option trader trying to decide, as we're building a new strategy, should it be bullish or bearish? Well, the S&P 500 and other major indices are right now at all-time highs. So the market has been very bullish. Does that guarantee the market's going to continue being bullish? Oh, it doesn't. It doesn't guarantee that at all. We could turn on a dime, but it's quite common for a chart trader to just decide to trade with the trend. Whatever it is that has everybody else enthusiastic, we're just going to assume that enthusiasm can hang on for the duration of whatever trade that we're about to choose. So that's what we're going to say here. Let's just say that our trader has the conviction that prices are likely to continue moving upward. Maybe not immediately. Maybe we get a pullback in the short term, but generally making higher highs and higher lows and just continuing in that direction. So let's do a bullish trade. And I'm going to do sometimes we'll do a long call diagonal spread to illustrate a bullish trade in this webcast series. Sometimes we do a long call vertical spread. But today we're going to be doing a long call diagonal spread. And I want to talk about the two different motivations for a diagonal spread: appreciation from the long option, but also income from the short option. And we're going to focus more on that second portion of the trade, the income portion. And we're going to put that in the context of what I call an income window on a chart. So here's going to be our example stock. Let's have a look at Alphabet, Google. What's been going on with Google? Well, very recently, it's been making higher highs and higher lows. It is earnings season, and we just got past this earnings announcement. So for a lot of companies, as we go through watch lists of some of these bigger, more liquid companies, we're going to see that those earnings haven't happened yet. Now, some traders will build trades specifically around earnings announcements. I'm going to take this position immediately following an earnings announcement. But what some traders might note here, looking at a chart, is that it's not entirely uncommon to see the outcome of an earnings announcement set this sort of the pace for the next 3 months. So, for example, coming into this year, generally, Alphabet was struggling a bit. Then we had initially a positive reaction to an earnings announcement, kind of similar. Look at what's going on with the day. Compare this to what we saw a few quarters ago. But we had a gap up and then a bit of a fade after that earnings. However, net a positive reaction to that earnings. And for the next 3 months, that was the general sentiment of shareholders. Then we got the opposite. We were going up, gap down in this case. That downward gap held, and it set the pattern for the next quarter. And it looks like we might have been started. Maybe there were some traders who might have been thinking, maybe things are getting better here a little bit. But here's our most recent earnings announcement before this one. Gap up, set the stage for the next quarter. Now, it's not a guarantee that from here the next quarter is going to continue being strong, but if our trader is just looking at recent history for a little bit of guidance, hoping that history will repeat itself, and there's not a guarantee that that'll happen, the initial reaction to this earnings announcement has net been positive. We're up about 2%, despite the fade since this morning. So let's just say that it's our trader's conviction that for the next quarter, things are likely to be generally positive for Alphabet. So if we think that things are going to go up for a few months, what might a trader do with that? On that assumption, maybe they go buy a long call. Now, what they probably don't do is buy a 3-month call, because if they're planning to hold on for 3 months, that's kind of maybe cutting it a little bit close, and it exposes the trader to a lot of time decay. So to provide a little bit more wiggle room on that trade and to minimize the time decay exposure, as a general rule of thumb, some traders might say, well, if we're planning to be in a position for 3 months, maybe we'll buy like a 6-month contract. So let's go to the trade tab and start to build our diagonal spread. And I'm going to go out about 6 months. Okay. That takes us somewhere into maybe the 16th of January, possibly the 20th of February. And we're going to be falling somewhere out in that range, around 180 days. I'm going to go for the 16th of January for this example. All right. Now let's open up our left column here. I'm going to use our scratch pad to build let's make this bold. This is going to be our example trade. A long call diagonal. Now, this long call is the trader's effort to take advantage of appreciation. So I mentioned that there are sort of two elements to a long call diagonal spread. So to take potential advantage of appreciation, the anticipated appreciation, we're going to buy the 16th of January. And let's see, our stock's trading at 194. If a trader is trying to minimize the impact of time decay further, what they might do is go some distance in the money. What if we were to look at maybe buying, how about we go with the one around a 70 delta? Delta can tell us how much a contract might go up or down in value on a $1 move on the stock, but it also can tell us the likelihood that a contract expires in the money and retains some value at expiration. This one looks like it has a delta around 71 or a 71% chance of retaining some value at expiration. Hopefully, we see a lot more value accrue. That looks like it's trading between 25.60 and 25.80. Let's say we pay 25.70 for that. So we're going to buy the 16th of January 180 call for 20. Did I say 25.70? I think I did. That in here. So what we're doing here is spending about $2,600, but for the next 176 days, the trader has the right to buy shares of Google or Alphabet for $180 per share. That's a current $194 discount on price. And what we're just hoping is that discount grows. If the stock goes up and up and up, if we're right about our next quarter forecast, that value could grow substantially. There's the potential for appreciation. Well, now let's talk about the income side of things. With vertical or diagonal spread traders, they have a dual motivation, appreciation and income. Now, to provide for that income, they'll typically sell a shorter term contract that maximizes the time decay benefit of selling options. And so for this one, let's talk about where the trader might identify a contract to sell. All right, and I'm going to use recent history as our example here. And I want to talk about this thing that I call an income window. So here is the appreciation potential that we might be facing. Just put ourselves in the shoes of a trader, maybe back here. Maybe they bought before earnings, maybe they bought after earnings. But let's just say it was around this 155, 160 level. Well, that stock has net climbed about, what is this now? $35, $40. So if we had the right to buy shares down here, and now the shares are worth $195, that's appreciation potential. If we can get that to repeat for the next quarter, that'd be great. But it's been a bumpy ride along the way. It's not just that the stock went straight up. Instead, the stock has had this tendency to move in a stair-stepping pattern, and that's very typical for stocks. They don't just go straight up. They'll tend to stair-step their way higher. Well, those stair steps can contain within them short-term appreciation potential, but also these pullbacks, not so much. However, those pullbacks, that's where the income enters into the equation for our diagonal spread traders. From the peak of one pullback until that peak is exceeded by price again, we might refer to this as the income window. So here's what I'm talking about. Let's draw in some rectangles here. So this peak right here, over to where price finally comes up and through it again, I might describe that as an income window. So here's another one. And actually, that one extended, with the exception of a couple of days right here, that was kind of a wider window. Here was kind of a narrower window, but a window nonetheless. So if you see what I'm talking about, in this case, this is a stock that kind of is doing the opposite of typical behavior in price. It seems to be bursting upward and then kind of drifting sideways and down and bursting upward, with some exceptions there. There are a couple of days where it really went downward. But yeah, let's phrase it this way. If we own a call right here, and then the stock behaves like this for 3 weeks, what's that doing to the value of that call that we own? It's not helping out much. It's not appreciating, I'll tell you that. Plus time decay is working against it. But if it's working against call owners, what's it then doing for call sellers at the same time? It's probably providing an assistance to them. That time decay is really optimized for a call seller. So these sorts of windows are what the trader is looking for income might be looking for. So how might we identify a window? Well, it really can be done in a number of ways. Maybe we'll use a technical indicator. But what a trader who uses charts might do is just look to see where have previous resistance and support levels been, and could those act as new resistance levels now? So for example, you can see the stock back here pulled down to about that, what is that, 165-ish level, and then rocketed up. Well, approaching it from the opposite side, if we've already been coming up, that previous price ceiling, price floor may act as a new price ceiling, and we pull back. And the stock goes up beyond that ceiling. What do we encounter next? So here's the lesson that a technician might be taking from this chart, is that history may provide clues regarding reversal points where that income window may be opening, where the appreciation window has closed for a while, and it might be time to sell our calls if we're looking to sell. So in this case, you can see our stock struggled at that point, pulled back, rallied up, maybe ran into these previous price ceilings, price floors here. You can see how we had price ceilings here. It acted as a pretty good price floor for a couple of months. And then approaching that from the underside, that became a new price ceiling. And in this case, that ceiling held all the way out through here. Now we've pushed up through that again, got a nice boost from an earnings announcement. But what may be just ahead here? For those looking for appreciation, it might be that there's a few more dollars of potential there, but there may be a ceiling overhead. So here's two different ways that a trader might react to that ceiling. Number one is they may choose to just wait to see if we can get on up to that ceiling and then sell a call just above it. That would be a pretty common approach among technical traders of diagonal spreads. If we think the stock is likely to go higher, maybe don't encumber it with a short call contract and let that thing run up a bit. There's a dual potential benefit to doing this. Number one, it can allow for appreciation in our long call, unencumbered. But number two, if the stock has gone up here, let's say that we think it's going to come up here and then pull back, and we're able to sell our short call, let's say we sell, I don't know, the 205 at that point, but selling above that resistance level, the benefit there is that we might get a bigger premium. I get a bigger premium because as the stock is going up, it's getting closer to the strike that we intend to sell. That might inflate that premium. That's a potential benefit. A risk of waiting for that sort of timing is that if we sell a premium that's closer to the price at the time, enhances the risk of early assignment. So there are pros and cons. But in any case, what the trader is looking for here to see if there is an opening of a window is where are the resistance levels above the current price, if any. In this case, it looks to me like there might be one up around $200. So should we just go sell a $200 contract right now? Well, now I also said, as sort of a premise here, maybe the trader waits for the price to go up. Other traders may prefer to sell while the price is still some distance below that resistance, because their timing might not be perfect. And in exchange for not getting as big of a premium, let's say we sell the 205 that's up above our resistance. That 205 is further out of the money right now than it would be if we were to wait, and if the stock went up to 200-ish. It's further out of the money. It's not going to be as big a premium. There's also just more, let's call it cushion, for timing issues. There's just more wiggle room for the stock to go up when we're, what is that, about $12 below that strike, versus if we were within $5 below that strike. Really, I should redraw this. Let me activate this drawing. Kind of drew it up at the top of that candle. We're actually down here. That's more representative of where we are. All right, so this is how a trader might use charts to plan for these things that we call income windows. Ask me, tell me if you have any questions about what do you mean by an income window, and how might the trader identify those again? So the income window is when the stock peaks and starts to pull back. from that peak until we push through that peak. We call that the income window. How might we identify those? Look to previous areas of potential resistance. Right? So let's go place our trade. I'm going to look to see what strike prices are available. And let's, in typical fashion for a short option, we're going to sell it and try to keep it probably closer to expiration. That's going to be speeding up the time decay there, but trying to get enough premium for the trade. So if we go too close to expiration, there's probably not very much premium. If we go a long way out from expiration, more premium, but more time for the stock to misbehave. So, there is an earnings. Well, the earnings announcement are in the rearview mirror. Anyway, so let's go back to the trade tab. How about we look out here? I'm going to go to the 15th of August. You'll see that's displayed in black. Those are the traditional third Friday contracts. The reason I tend to go to those in my example trades here is because they tend to be more liquid. The weekly options, as we just saw with GILD, they tend to be less liquid and they can get very wide spreads between the bid price and the ask price. Not all of them. Probably not, as a matter of fact, on Alphabet. But I'm going to go out here to the 15th of August. Anyway, those are 22-day contracts. And if I look at the 200, there's also a 202.5. That's also above resistance, a little closer to the current price. So that might allow us to get a bigger premium, but also elevate the risk of assignment. It's like we might be able to get about 225, 230 for that. Chuck says, Cameron, why not a calendar? Chuck, we could do a calendar if first of all, if the trader is quite confident of just the point to which they think the stock is likely to go, because a calendar works out best. It's sort of true for a diagonal anyway. If we go right up to the strike price of the short, but here's another thing, Chuck. This webcast series isn't called Long Verticals and Calendars. So, yeah, I limit myself to the strategies that I advertise for the series. So, yeah, there's your logic. Anyway, let's stick with our initial premise. How about if we sell the 205? That's going to be all the way up here. What other potential advantage do you think it might provide to our hypothetical trader here? Well, that coincides pretty neatly with a previous resistance, a second previous resistance. So even if we broke through the first, we'd have to get through a second prominent peak. All right. And that would have to happen before that 15th of August. Not terribly likely, could still happen. But that's going to be our income. We're going to try to take advantage of this apparent income window. And let's just make it our plan there to sell the 205. So if we are, here's our diagonal spread net. We're going to sell the 15th of August, 205 call. And that looks like that's going to bring in about maybe $1. I'm going to call it $1.75. We don't know, approximately. So between those two contracts, we're spending a net $24. So who's the real driver of this trade? Obviously, we'd like to see that long option continue to appreciate in value. And this is just a little bit of icing on the cake. That's I think, an accurate way to look at a diagonal spread. Jim says playing it safe. Well, yeah, Jim, I would say we're probably playing it safer. Yeah. Safety is an illusion in options trading. Nothing is safe as long as we're in an options contract. Things can go wrong. Yep. But let's place our trades. And while we're here, I'll just show you a quick way that we might choose to place this trade. Since we're already here at the 15th of August, I'll go to the strike price that we intend to sell and click on the bid. That creates an order to sell down below. And then we can just go back up to the option chain, go out here to the 16th of January. And I believe, let's see, we were looking at selling the cheat over here. It was going to be the 180. Now, I'm kind of using this little tiny window that I'm peeking through. We can also just minimize the original order here. Let's click on the minimize. That just parks it down at the bottom. And then we can see our option chain a little more clearly. And let's hold down the control key on our keyboard and click on the ask price. There we go. And we were thinking it might cost us about $24 net on this. maybe about 23 and a half, to buy the 180 for the 16th of January, sell the 205 for the 15th of August, and let's say we're willing to spend a little bit more. Let's say we're willing to go up to 2370. That's going to be closer to our natural. Actually, at this point, it's above the natural. That's okay. I'll zip it over there. That'll work. Anyway, let's click confirm and send, and we're going to buy this diagonal spread, 16th of January of 2026, 15th of August 2025, 180, 205 call spread, limit of 2369. That would be the net cost of trade. Let's actually maybe do 2 contracts. We typically invest around $4,000. This would be a little bit more than $4,000. Let's edit this and just crank this up to 2. I normally do just 1 contract. Let's do 2 on this diagonal spread. Anyway, that increases the investment in the trade. It also doubles the amount of commissions to be paid. But the preference now is for the stock to go up, helping out our long call, but to stay below 205 as we get toward that 15th of August expiration. And we'll send that order off and see if we can get a 2 for 1. That would be appreciation within the income window. All right, but we have, was your mind blown by that statement? Safety is an illusion in options trading. Yeah, safe is a big word. It's a big word. There are degrees of safety. We fall somewhere along that safety spectrum from not safe at all to very safe, but absolute safety, nope, not a thing in options trading. Anyway, guys, we've accomplished what I set out to do today. I wanted to, yes, review existing positions, take a quick look at the markets, but also talk about this thing known as an income window and talk about how a trader might use a chart to plan a diagonal spread in an effort to identify those income windows. So we've put that into practice. We'll see if it works. Time will tell. We'll follow up on this webcast, follow up on this trade in future webcasts. So I hope that you'll join me in those future webcasts or just watch the archives for them. That works just as well too. But thanks for giving me your time today. Couple of suggestions before I let you go. And by the way, I have tomorrow off, so I'm going to bid you have a great weekend. But make sure that you're taking advantage of all of your educational resources. The first, obviously, is this YouTube channel. So go down, click on the subscribe button if you haven't done that already. Click on the subscribe button. Doesn't cost anything. It literally only takes a second. But our YouTube channel is where we house our previous webcasts. So you can go watch them if you miss them. Or you can just watch them at your leisure if you don't plan to attend the live ones. You can find these playlists right here. You can also join the live streams right there. And if you have an interest in a specific topic, maybe it's diagonal spreads you want to really focus on, you can just type in the word diagonal, and it'll just bring up previous webcasts that focus specifically on diagonal spreads. All right. So that's one resource. Also, make sure that you're following your favorite presenters on X if you have an account with that platform. You can follow Brent there at Brent Morris CS. You can follow me on X at Cameron May CS. As I mentioned when we kicked off this webcast, I was in here reading through the comments on my most recent post here. So I just posted this. NASDAQ Composite has had nearly 5 weeks, it's only Thursday, so we don't know for sure, but nearly 5 weeks of white candles. Strong move, but it's not unprecedented. You can see several examples just over the last couple of years where we've had a 5-week run or more. So what do you think the color of next week's final candle might be? Is it going to be another white candle? Is it a red candle? That may inform the way that a trader takes positions moving into next week. So that's interesting. People can give me their feedback. I like to see what others are thinking about things. But that's where we can communicate with our presenters in between these live streams. So Brent, again, at Brent Morris CS. You can find me here at Cameron May CS. All right, everybody, go enjoy your day. Make sure you fill out that survey. Not an everyday opportunity to get to fill out surveys for your presenters. And thank you for clicking the like button. That's always appreciated. If you give us a quick thumbs up when you enjoyed a webcast, it's a pat on the back to the presenter. It also, though, has a direct benefit as a boost in the YouTube algorithm, helps more people find these webcasts so they can learn things like how charts might be used to identify potential income windows when trading diagonal spreads. All right, everybody, go have a great rest of your day. Enjoy your Friday. Have a great weekend. I'll see you on Monday. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.